Good afternoon. My name is Michael Stoller, host of the Stoller Report and moderator for the AmTrust Title webinar series. Steve Napolitano, Senior Executive Vice President of the AmTrust Title. Today, the topic of discussion is the hospitality industry, an industry in a crisis today. My guests today include Brennan Keating, who is the Administrative Vice President, Specialty Financing with M&T Bank. We always need a lender. We have Larry Korman, who is President of AKA Residences and co-CEO of Korman Communities. We have Dilip Petigara.
That's correct.
Okay, who's the CEO of Access Point Capital. And last but not least, we have Ben Davison, who's the Hotel Asset Management and Acquisitions for RFR Holdings. So where's occupancy today? What's happening? How is it getting a little brighter? You know, as many people I say, I have a crystal apple normally on my show, which would be very dull because I don't see the positive market today. Larry, you're the ultimate optimist. Where do you see the hospitality market today?
I'm very bullish. I think there's going to be great new opportunities. I think a product like what we offer is going to resonate in the near future. When we got out of the recession, more people were willing to take a chance on AK, which was not known. So I'm very bullish about the future. The properties where we've done the longer lane stays have benefited. They're reaping those dividends. So we have some properties in the 65 to 85% occupancy. Other properties in Philadelphia and New York where we just experienced our lowest season, which is Q1, we didn't have the same base. So we're in that 25 to 35% range. But we're really battling to keep everybody working, and we are hopeful that the city opens back up in May.
Ben, you have luxury hotels in New York and around the world. Where do you see your marketplace?
Yeah, I mean, right now we're mostly shut down. I mean, largely, you know, we have a lot of mixed-use properties with some condo components, so those are still open and operating. And, you know, we still have staff to service those residents. You know, maybe not quite as bullish on the rebound as Larry, but, you know, we're hopeful that leisure is one of the segments that comes back faster than some of the other segments. So we're optimistic that those markets will rebound quickly. But as of now, we're mostly, you know, just humming along and, you know, trying to manage expenses the best we can, and, you know, with low occupancies.
Brennan, as the banker, what percentage of your portfolio would you say made the April payments?
Of our portfolio, I would say probably 2/3 of our portfolio made the April payment. So, but even the ones, 1/3 of our portfolio made the April payment. 2/3 did not. But the ones that, even the ones that did not, or the ones that did, we were still offering some relief to them. It's just that was it some timing issues, and some of them still had the cash flow to be able to support it.
Dilip, you know, you're based in Atlanta. How do you see, and you're an intermediary, you provide intermediary financing with people. Where are your clients today? How are they reacting to the market? And are they asking for forbearance in their loans today?
Yeah, I mean, just a point of clarification, we're actually direct balance sheet lenders.
Okay.
So, you know, we have, you know, we've touched base with virtually our entire portfolio. We've talked to all of our borrowers. And, you know, we are offering them, you know, based on what their needs are, depending on the loan type as well. You know, whether it was a loan for FF&E, those loans typically amortize over the life of the useful life of the equipment. So in those cases, just making a modification to the loan to permit a waiver of the principal for a 90-day period where they can continue to pay interest, that's feasible for them. Or other loans, particularly on the acquisition with a reposition, we have a mortgage component on it, then in those cases we are looking at either interest only or doing some sort of 90-day deferment. We're taking it on a case-by-case basis and looking at it on a 90-day window, and then we'll reevaluate 90 days from now what their needs are, depending on where they're located and whether those markets, you know, start reopening.
Okay, the big question is 90 days is very short period of time, and it's going to take a little longer for most things to reopen. Do you see the banks extending the opportunities to 6 months deferral of interest and perhaps 3 to 6 months deferral on principal payments? Because otherwise, I'm not certain too many of these properties can pay off the debt.
Well, at least for M&T, I mean, we're looking at these, we're giving, 90 days for many of our loans. However, we acknowledge that 90 days likely will not be sufficient, but, we're hoping 90 days from now, we're going to be able to have some more visibility into kind of how deep and how long lasting this COVID, crisis will have lasted. And then once we have a little more information, we'll be in a better position to know kind of how to modify for any additional term that we would need to.
Ben?
Yeah, we're seeing most of our lenders in the same boat, trying to give us some runway, pretty much 90-day forbearance with cash sweeps thereafter to try and get that debt service paid back as quickly as possible. And most of our close relationship banks have been pretty accommodating, understanding this is unprecedented times and that we all need to get some runway to figure out exactly what the world's going to look like and can manage from there.
So, let's talk about the world where it's going to look like. Right now, I've been reading in the paper, the hotels which are open are spending probably double or triple the expense they did on cleaning and sanitizing the rooms. It's taking longer to move somebody from one room to another room because you want to make sure it's protection. How are you in the hotels that you're operating today operating to handle the coronavirus pandemic?
Well, partly we were spending double or triple because we have local 6 and residences. But beyond that, I think similar to when bed bugs hit New York, we've always resonated with those who want quality, design, presentation, cleanliness. So cleanliness has been a hallmark of the AK brand. And I think what you're going to see is people are going to care a lot more about that. And it's not going to be up to the government to decide when people stay. It's going to be when people feel comfortable staying. And I think where they go, and I think it'll be more quality than quantity travel. So when they stay, they may stay longer, and I think they may stay at a higher level. So I think it's going to be an opportunity for us to have more people willing to try AK or stay with a group that they believe is going to really protect them.
I think what you're saying, sorry, Ben, I'll be finished in a second. One of the comments that was written up the other day on extended stay, that many people are very happy with extended stay. It's a segment of the market that's doing well, and some of the major players are looking to put money into the extended stay. Ben, you were saying?
Yeah, I was just going to piggyback. I agree with everything Larry's saying. I think that the brand component to this around cleanliness and getting consumers from a psychological perspective comfortable with staying is going to be a huge factor with getting people back into your property. I mean, you saw today and yesterday, Marriott released their new global standards for cleanliness. And, I think that's going to be a huge component to reopening and getting people back into your property.
I have a question with regard to financing, whoever wants to take it. I mean, there was a discussion, and it was also written up in your paper, the Philadelphia Inquirer, Larry, talking about construction loans for hotels. There were a number of construction loans in process in various stages. How do you see, are these construction loans going to continue, or do you think the properties are just going to be dormant until the world becomes a different world? Brennan? You're the banker.
Well, I mean, we have a number of construction loans that were halted due to, regional requirements. So what our expectation is that once these cities and municipalities open back up again, we will continue to be funding those construction loans. We know that, we're going to have to push out construction completion dates and some of those as well, and kind of, the opening of the hotels. And we've already started that process. But we fully intend to continue to funding on those projects.
One of the biggest topics over the last couple of years in the hospitality business has been Airbnb, Lyric, Verbo, and the other alternative entities over there, and Sounder. How do you see these entities reacting in the future?
I think they'll ultimately and eventually do well. I think there will be this question, both based on regulations from the Jersey City vote that happened pre-corona time, but I think there's just going to be an overall question about staying in somebody's apartment versus staying at a brand where they know that there's systems in place to deal with some of these things. So that might be an 18-month versus beyond that, but I think there's a way in which everybody can partner together through distribution, through programming, through management. But I think there will be this, especially within urban cities, dense populations, this desire for something that they know to be, they have that credibility that it's going to be contained and controlled and clean.
Which I think is evident by the Sounder and the Lyric approach, because they're really renting apartments for the entire apartment as opposed to sharing a portion of the apartment over there.
Some of these younger companies were getting so much cash because of the technology, and I think you are going to see a flight towards more established companies that have the breadth and depth of experience similar to Korman Communities and some others. But I think that technology component will resonate, but maybe in a different way.
What about the resort?
Yeah, I think the one concern though with those companies is most of them were appealing to landlords because they offered a fixed, sort of lease structure to come into your property. The question is going to be after this, many more months of this, are they going to be capitalized enough where there's anything behind these lease payments? So you're just taking a flyer on them. And let's remember, a lot of these were spin-offs that were supported by Airbnb, like Lyric. So it's going to be interesting to see if they still have the capital to weather this. And I agree with Larry's point that I just think the consumer is going to have a tough time getting comfortable going into a random person's apartment with no idea on the cleanliness standards, and maybe they're going to flight back to some of the brands and known product.
Also, if you think apartments have done very well in New York, if you own an apartment, would you take 2 floors right now and give it to somebody that's not as stable as a 1-year lease?
Definitely. Vail Resorts recently issued their financial results saying that they did poorly. Disneyland said they may not open up until 2021. Dilip, you did a wonderful financing in Aurora, Colorado, near the Gaylord property. What do you see with regard to the resort properties when they return, and what the changes will be in the processing of handling people at these resorts? Brennan, you used to have a major resort property, the Roosevelt in New Orleans also.
Yeah.
Well, I think, the resort properties, there will be, at least in the short term, there's going to be enhanced procedures to check in. There's going to be, as Ben talked about, just similar to what Marriott just rolled out in terms of cleanliness programs, there'll be enhanced programs for that. I think the F&B outlets may not be operating as they did in the past, if at all. They'll go to some other limited touch and limited contact type service. And I think that you're going to see that, starting at the resort level, but then also working its way down, where, you start limiting the touch in the rooms. And, you'll have to kind of figure out how you, in the short term, even reconfigure that space, particularly when a lot of these brands and a lot of these chains were going towards activating more of that public space for having people kind of mingle there and provide, whether it's a coffee offering or a bar offering or something else. So it'll be interesting to see where that shakes out. But, the resort properties will certainly, start there. And the key will be the beds and heads. And then that will start, as time progresses, then maybe they'll be able to provide additional amenities and services that you're typically used to seeing. What'll be interesting is what rate will they be charging, for that, because you're not getting that same level of touch at it that you were probably obviously pre-COVID.
And for these resort hotels too, it's going to be what kind of guests they're going to have. So I mean, most of the people I've spoken with, it seems to be the consensus is the leisure market will be probably the first one to come back, and specifically the drive-to leisure market. So the ones that have that sort of clientele are going to probably come back quickest. But for some of these resorts that can't rely on that, or have a greater reliance on group business, which I think will probably be the last to recover, they're going to have a prolonged stress for looking at years more than just months.
Here's a question that, Ben just brought it up, and I think Dilip included it, is the subject of F&B in the restaurants within the hotels. Many of the restaurants will have to change their proximity, their social distancing, the number of people, bars, you know, the Moxie, who did very well in New York City because of the Tao effect and everything else, it's going to change. How do you see, and in many of your hotels, part of the business was tied in to the fact that you had this fancy restaurant or this luxury type of lifestyles. How do you see that affecting the future of the hospitality industry?
We've actually, one of our restaurants at aka Rittenhouse Square provides meals to our residents because it's a full residence with a full kitchen. Sometimes they're just providing them utensils or ingredients. We have Samsung TVs that allow them to do nutrition and cooking and fitness. So I think one of the things you're going to see is more home offices, people working from home. So we're putting a greater emphasis on our lighting and some elements like that, but then also this ability to cook in your own home and not have the pressure to go out for each meal. So we're looking at how food and beverage around us, not just in our buildings, but around us, can complement that.
And you, in your New York City hotels, you have very fine restaurants. What do you see happening over there?
Yeah, I mean, let's be honest, and hopefully none of our my tenants are listening, but you know, they're a critical component to the success of the property, especially on lifestyle hotels. You know, we're optimistic that, especially in New York, that as things settle down, that the normal will come back. And I do think you're going to see an increased demand for, you know, potentially room service and cleanliness if you're packaging it correctly. So we're hopeful that we can get these guys back up and running, but look, there's certainly going to be challenges. There are challenges with getting labor back up, getting labor, you know, back to in and providing working capital for these restaurants to get back up and running.
You know, one of the topics that always takes place with over the financing, when people were looking at hotels and at restaurants, it's a day-to-day operation. You know, the income changes by the day. How do you see, with regard to the day-to-day operation, the financing abilities? You know, there are certain balance sheet lenders like M&T Bank, Bank of America, who's been lending. Then there's been the CMBS market, and then there's been the EB-5 and alternative financings. Who do you see in the future being a leading lender in this market? And do you see the EB-5s, who is really a subordinate lender of foreign money, continuing to have a business in the U.S.? Ben, have you used EB-5 financing?
Yeah, no, we have not actually played a huge amount on the EB-5 side, but look, most of it is tied to construction. I think that you're going to see, obviously, new construction starts significantly decline given the risk of hospitality assets and the ramp up right now. So I think EB-5 is going to be significantly diminished in the hotel front. I mean, it probably will continue in other asset classes, but if you're asking specifically about EB-5, I think it's going to pretty much be non-existent because it's hand in hand with construction.
Dilip or Brennan?
I mean, we've done some EB-5 projects historically. I think that the answer to that question is really tied, you know, also to kind of immigration policy and you know where the dollar amount is for the initial investment in exchange for the green card, if you will. But you know, in terms of construction projects, you know, of the ones that we had on our books that we were lending to, are still continuing to lend to, those projects continue unless there's a regional, you know, shutdown, if you will, for construction. And as Brennan talked about, we evaluate that and then the delivery point of it and how that impacts the interest reserve. But for going forward projects, I mean, we will look selectively at, you know, some new construction projects. Certainly, it's harder to underwrite, particularly on a valuation basis, you know, as complete and as stabilized. But you know, we're looking at those in terms of probably lower leverage going into the property, and certainly, you know, maybe underwriting a little bit more restrictively in terms of debt service coverage than we may have historically, and really focused on the sponsor's ability to, you know, cover costs and you know, if they're close to opening a property, then certainly their first year of debt service coverage, if you will, or interest payments as the property's ramping up. You know, certain properties you mentioned, Aurora, Colorado, that we had financed, that property's almost open, and they're kind of slowed it because, certainly they don't want to open in this environment, but they may, in the next 60 days or so, decide to open that property. So they at least had, that short-term advantage in terms of not having to close the property, and once they do open, then they'll open fresh. So I answered a few questions there, but
It did.
Hope it made sense.
Yeah. And from M&T's perspective, on construction, a lot of it's going to come down to how long and how deep this downturn is. So we're not really looking at any new construction for hotels right now. I don't think anybody probably is. But once the kind of dust settles and the smoke clears, we're going to kind of see where we are, and we may do things selectively. There's some markets which maybe oversupplied coming out of this. New York is likely to be one of them. I think there's probably going to be a number of hotels that may not reopen. So we're going to kind of just have to see what the landscape looks like coming out of this. And for M&T, all of the clients that we would be lending to for hotel construction are owners and operators of other hotels. So we're going to have to see how impacted, what their situation looks like coming out of this as well, because they will be put in a situation where they're going to be carrying these properties for some time. And if there has been any, deferment of debt service, that deferment is going to need to be repaid for any other distributions go back to those ownerships. So that's going to impact their cash flow going forward as well, which we look at as a key factor for, underwriting on those construction loans. So there's a lot still to be figured out during this for us for construction. So it's going to be some time probably till we're seriously considering anything.
So here's a question, because most of you have been involved with franchise hotels, branded hotels, that you have to pay an annual revenue fee based on revenues, okay, and then you also pay a fee based on FF&E and an advertising budget. Do you believe that the national brands, in light of the world that we're in, are going to reduce their charges for these fees?
In essence, they have by the reduction in revenues.
No, they're going to have to. The reduction of revenues is going to cut it down. But I'm talking about, it's hard enough to operate a hotel when you're at 90% occupancy. When you're at 60% occupancy and you're still paying the expenses over there, the advertising and the other budget, it has a major effect on your bottom line. Do you think that people like Marriott and Hilton will put it in mind and reduce their charges?
I think it's, look, a lot of these brands have longer term, contracts. I don't see them making concessions on base management or incentive fees on some of those, on in-place deals. Where we're optimistic, where we maybe can get some relief, is some of these shared services and chargebacks, where, maybe on the corporate level, there are some reductions, and some of the inflated marketing budgets will not be as robust, and maybe some of that will be passed on to the owners.
With regard to what you just said on reductions over there, have all of you or any of you applied for your hotels the PPP program?
We haven't. I think it's intended for companies like ours who have really battled with our partners who have been spectacular to try and keep as many team members working as possible. So we're in that process and moving forward with that.
Ben?
Thanks to M&T.
Happy to do it.
Exactly. Yeah. We're spending a lot of time on the program, and we are all for bringing our employees back and trying to get them compensated as quickly as possible. And I think there's a lot of positives about the program, but there are some nuances around forgiveness that I think still need to be worked out, particularly around, how do you bring back employees, especially when this booster for unemployment insurance of $600 that goes out 4 months is potentially more lucrative and has your employees making more money staying on unemployment. And the reality is, we're in a situation right now where it's not safe for a lot of employees to come back to work, and businesses are not reopening. So the forgiveness calculations in the PPP structure are a little bit challenging. We're hopeful that the government, when they come out with new regs in the next sort of 48 to 72 hours, addresses the forgiveness component, maybe pushing out the 8-week start date, maybe helping with some of the 75-25 splits. But I think the structure is there where, and the spirit of trying to get employees paid and back to work is spot on, and we're optimistic that we can use the money. But at this point, it's tough to take it given these couple of constraints around forgiveness.
Especially for restaurants who are told they can't open up, and even when they do open up, have to open up in small amounts. So I agree in terms of the timing, pushing that back for certain groups like restaurants.
What about the subject of, New York City has been entering a program, the mayor, with regard to putting people who were in hospitals with COVID in their hotels. That's one program. Then there's the program with regard to shelters. What do you think about all these programs that the city is trying to implement? And I assume they're trying to do it in Georgia and also in Philadelphia.
I think it's great that they're doing it, that the governments and the hotels are working together. There's a lot of hotels that have that space. I know both Four Seasons in New York have been above and beyond. We're trying to work in our own way through one of our partners, our majority partner, in helping NYPD. We're working with a lot of healthcare professionals. We're working with another group through the state that I can't talk about. But I think everybody first looks at their partners, their team, their residents, and the community. And I think everybody has really rallied around their communities and tried to step up in ways in which they can.
Here's a question with regard to, there are a number of luxury hotels planned to open up in New York City, including the Virgin. And there was an article written about Richard Branson and financial difficulties. I believe that certain of these hotels, which were luxury brands, will open, or they will change to be more of a limited service because there's not really the need, or people want the luxury brands more than the limited service.
I mean, I completely agree with that. I think there's going to be, again, this rush to quality because so much is going to be managing expectation, managing perception. People are going to be fearful for a while. It may change. It may, as Ian Schrager said, go right back to the way it was. And I'm hoping there's a balance to that. But I think there will be this push to quality with respect to cleanliness and security and comfort and value.
A significant portion of hotel revenue in many cases is dependent on catering and events. With the events being reduced, what effect do you see on the hotel business? Because when you had the events, you had people come to the rooms, then they would have food and the variety of things, and many things like Gramercy Park Hotel. A lot of people would have weddings over there because it was a beautiful place. Right now, we don't know what's going to happen with the situation. Where do you see it?
Yeah, we're working with, obviously a lot of these are forward bookings, right? So we're working with all these groups to try and reschedule and try and book for later on when we have more clarity on what type of events are allowed. But I think it's certainly going to be some challenges, going forward. I think the catering business will probably be okay. I mean, the bigger problem you're going to have is a lot of these big group boxes that are so dependent on banquets and group business. It's going to be harder to ramp up for them just because these are things that are booked 6 to 12 months out, and we don't know what the government regulations are going to be around social distancing and capacity concerns. So I think it's just going to be an added stress for some of these big box and group focused hotels to reopen.
With regard to, there have been a number of airport hotels, like the one that you're doing, Dilip in Aurora, is right near the airport. Okay. And then there are numerous hotels at the airports in the city and other places, especially even in Philadelphia. What effects with the limited travel do you think it's going to have on the airport hotels?
Single digit occupancy, 10%. Maybe they're still getting some of the airline crew business if they were serving that. But that was always lower rated business anyway. It's going to be a challenge. I mean, but they're all operating at bare bones. And these properties tended to be, a little bit more full service, if you will, if not fully full service, but, have more of the amenity offerings, maybe a restaurant on site or a bar. And that's impacted, those various lines of cash flow that's all contributed to the hotel. So it's going to be a long road, for them, just like it is going to be for, the airlines, during a recovery.
What about the OTA business? Do you think the Expedia, the Pricelines are still going to be a major benefactor to you, or are people going to go direct?
We've always, because we are more quality of individuals for longer length stays, so we've always been a little bit more self-sufficient and a little less dependent on OTAs. I think they're exorbitant. I think they're primarily for daily business. That's not who we are. We're a blend between hotel, condo, apartment. But I think you're going to see some competition coming from Airbnb towards them. I think you're going to see the whole segment reduce their fees a little because it is exorbitant.
Do you see the roles of alternative lenders increasing in the hospitality market? Because banks may be staying close to the vest in today's world.
I think, yes. I mean, certainly I think everyone's going to be cautious, and certainly we don't know what the recovery is going to look like and how long this is going to be and what that uphill, climb is going to be. But I think as banks, traditional banks pull back, non-banks will see an opportunity, and they provided that the remainder of their portfolio remains healthy enough, then they'll be able to accommodate some of that demand. It'll be, again, probably higher rates, lower leverage, and certainly the more attractive projects or assets that they historically may not have been competitive in being able to obtain because they didn't have access to the bank cost of funds.
I think some of those alternative lenders may have portfolios that are stressed right now, though, too, because they were going in and they were coming in on transactions with higher leverage, a lot of times non-recourse, and then in many cases levering those loan portfolios too. So there's going to be there may be margin calls for some of those groups. So there'll be some that'll be fine, but I think that some of the lenders in that space are under even more pressure than the banks are right now.
Here's a question, and I think it's really related to Larry and to Ben, and Brennan may have been involved in this. Significant number of people, like 67 million people, came to New York last year. Needless to say, the number of people are going to drop. A large number of them went to Times Square, where Larry, you have a property, and Ben, you have a property. What do you see, because of the social distancing and every effect, how much effect is this going to have on the Times Square properties in general? Not yours, but all of the hotels in general.
Do you want to go first, Ben?
Yeah, thanks for that, Larry. Look, I think Times Square has certainly already had some rate issues in terms of trying to drive occupancy levels. I don't think Times Square is going to have such a, New York's a crowded place no matter where you are. I don't think Times Square is going to have such a crazy, drop in occupancy that people are going to avoid it. I mean, I do think there's going to be a ramp up with the theater business, given it hasn't reopened, and there might be some demand drivers in Times Square that lag a little bit. But I think ultimately, if travel restarts, people are going to want to come to New York for New York, and I think that includes being in Times Square.
From our perspective, I think just as international travel isn't coming to New York, domestic travel isn't going to these other international destinations. So we're really focusing on domestic travel, and we're taking it quarter by quarter. So this summer, Broadway is going to be back by mid-June. That should certainly help Times Square. We generally have people who are on the playbills who are in the theater, the directors, executives of the stars staying with us on a longer length stay. But as Ben said, the ADRs have never been great in Times Square per se, but I think all of New York's going to look for different segments to attract back, whether it's for a couple days or for several weeks or several months, which is the sliver that we go after.
So where do you see, in summation, before we close, where are the opportunities going to be in the hospitality industry in the next 12 to 18 months? If we open up in June or everything else, where would you want to be? What do you think are the best approaches for each approach? Dilip?
Well, I mean, as a lender, I think we're going to have an opportunity to, again, attach to certain projects at, lower leverage points, certainly higher, rates than maybe we saw pre-COVID, and be able to benefit from more attractive projects. And I think that those opportunities will exist. I think that we are going to see, as someone else mentioned, that some hotels may not open again. So that this supply creep, new starts will have stock, but then even the existing supply, I think that we'll be able to see better and healthier return to occupancy over time. I think the biggest thing will be people getting over their concern for the travel, and then the fear associated with the virus itself. But I think that once that is overcome, then I think that the industry is probably going to be a little bit better off long term. And I think we all share the same optimism for the long term prospects and success here.
Ben, since you were the one who brought up the fact that you believe certain hotels are going to close, what percentage do you think are going to close in the metropolitan area? If you had to make a guess, 10%?
Yeah, I wouldn't be surprised if it was a 10 to 20% closure. I think a lot of assets that were having some trouble or maybe don't reopen, and maybe some get forced for alternative uses, which I think overall will help the recovery here.
When you say alternative uses, do you think we're going to do like we had 20 years ago, a lot of hotels being converted to condominiums? Or rentals?
I mean, look, I don't know if condominiums given the market, but look, I think you're going to see some converted to office. I think you're going to see some of the Lexington Avenue, corridor, a lot of these big box hotels that have already closed, maybe get knocked down and eventually get converted to office. I mean, maybe there's a shift at some point to some micro residential where, as people are continuing to have, be priced out of the city. But I do think that there's going to be some significant closures, and I think assets that are high quality, mainly more leisure focused, there's going to be, a lot of growth in New York, and maybe, some of the closures will fix the supply issue that New York had and help it rebound even faster.
With what you just said is very important about the Lexington Avenue properties, because the Lexington Avenue properties are in the Midtown rezoning. So if you took down one of these properties, and it's much easier than taking down an office building where you have to buy out the tenants. Here you don't have tenants, so you have an easier accessibility, and you can increase the size, which is a good example of what they were planning for the Grand Hyatt anyway. So this could be helping increase different types of properties opening up in the Grand Central neighborhood. Larry?
We're going to champion the basics, really stick to our knitting, and internally we're trying to really reduce expenses, get a little bit more frugal, really try and do away with dining dailies, which we weren't doing much of, but really be smart how we build for it. Externally, we want to communicate to a new group. We want to connect with the new group and really get out there our dedication to cleanliness, some of the new policies we're doing to really meet those needs, and for them to hear what they're looking for so that they feel comfortable not only traveling but staying with us. Even a little thing, we're going to have a sleep mask when they come in for while they're in AK, and then a mask they can wear out branded when they're outside of AK. So continuing to bring that calm from their chaos.
The AKA vodka and the AKA Chardonnay, there's going to be AKA masks.
Yeah, we've shifted the AVOD and AVIN to an AK Cares package, which has a lot of things they'll want. We're adding apps so the call buttons for the elevators can come. So it's really going to be geared towards subtle shifts, reducing expenses, shuttle shifts to really having those elements that resonate with today's customer for the next 12 to 18 months.
And now I go to the man who has the money. Where do you see the opportunities and changes?
I mean, the opportunities, I like Larry's comment to kind of back to basics. I mean, we're going to be looking at kind of supporting our existing customers, the ones we've had long-term relationships with, and really cementing those relationships where there may be kind of, pieces of business that we aren't covering with them currently. And then there's, a list of a couple probably prospects that we're looking to probably bring into the bank. And we're going to probably try to support those folks, over the next 12 to 18 months. A lot of my strongest relationships have been developed during times like this. I mean, a lot of our hotel business kind of came from, the strength of that came, during the crisis in 2009 and 10. So the way we acted during that time allowed us to build up the portfolio that we've enjoyed over the last decade. And we're going to be kind of reinforcing those relationships again over the next year and a half.
I think, as we saw from 9/11, as we saw from the 2008 recession, New York and the nation is resilient. We will overcome this. I'd like to thank Brennan, Larry, Dilip, and Ben, and see you at our next webinar produced by AmTrust Title, Stephen Napolitano. And thanks again.
Thank you, guys.
Thank you.
Thanks, guys.